Welcome to the Lighthouse Financial Advisors Money Over 50 podcast with Dallas Davison and Michael Hogue. This information is general in nature and does not take into account your objectives, financial situation, or needs. Therefore, you should consider whether the information is appropriate for you and your personal circumstances. If you require personal advice, please contact Lighthouse Financial Advisors. Here are your hosts, Dallas Davison and Michael Hogue.
Yeah, so that's about right. Yeah. So and here's the thing: people always measure the previous highest point to the lowest point and say, okay, things fell 57%, and that's true. So from the previous highest point, which occurred in November of 2007, to the bottom, which was 9th of March 2009, the total fall. In the American markets, the S&P 500, America's largest 500 companies, our largest 200 companies in Australia, around 57% for each of those. Yeah. So, look, 6 months after that bottom, what had happened is that the price had pushed back up to, it wasn't quite 4,000 points. I think it had jumped quite a bit. So it had pushed up from 3,150 points to nearly 4,000 points. So, I mean, think of that as...
So what would that have been down from previous highs?
It was... so what were we talking about? We're talking, I think it was about 40% or 35 to 40% from the previous highest point. But the thing is that if you measured it from a few years beforehand, and you'd put money in along the way, starting from even say back at 2005. Then 6 months after the bottom of the global financial crisis, you're basically back to where you'd started at that point in time.
So let me just check I got this right. So basically, assuming that if you had $500,000 in your super, for example, in 2004, you fully invested that in Australian and international companies, that would have pretty much doubled over the next 3 years. So your 500,000 grew to $1 million, and then it dropped by 57%. So your $1 million dropped to 430,000, and then 6 months later, basically, we would have been up to somewhere around 600,000. Is that about right?
That's about right. I mean, I wouldn't take that exactly as gospel. We'd have to do some more math on that, but look, it's close enough to the mark.
So what I guess what would be, I think, interesting for most people is, that's a pretty it's easy to sort of talk about those figures and this percentage and this much of a drop and the rest of it. What was it like experiencing that at the time, as both as someone who was, I'm sure, invested, and also as an advisor? What did that feel like?
Yeah, look, obviously getting to live and breathe it every single day since 2001, I was completely comfortable with the fundamentals that every drop gets to a point where it turns around and recovers. What had happened, I recall though, in October of 2008. So the markets reached a peak in November of 2007, and then they started to fall as more and more bad news came out, and they then paused somewhere at about 4,300 points. Now, let's revert this to dollars. So they got up to 6,800 points, the ASX 200, November 2007. Let's just put that into dollars perspectives and call that $6.80 per share. They fell to somewhere around the 4,400 or $4.40 per share by October of 2008. And then there was a 1 week period where things actually fell by about another 14%, as Lehman Brothers, a big investment bank in America, went broke, And then look, there was financial institutions all around the world going broke at that point in time.
Yeah.
And that caused another wave of panic. So things dropped quite a lot in a really short period of time. So it dropped under $4 a share, or under 4,000 points.
Yeah.
And finally bottomed out in March. I remember thinking at the time, look, I certainly won't lie to you. After it broke through 4,000 points, I thought, when is this going to end?
Yeah. If you revert that to,
people certainly were panicking at that point in time.
Yeah. And I guess and that's why it's sort of interesting looking at different drops at different times and what caused them, or what the emotional state was at the time. Because I guess I wasn't actually in the industry, but I remember the big fear at that time was about what was those financial institutions. So you kind of going, not only are companies' prices dropping and profits, are they downgrading earnings targets and those kinds of things, but there was issues with liquidity of those banks in America and that kind of thing. And so that was probably, I'm guessing, what was a source of panic for a lot of people, was that it wasn't sort of something easy and tangible to be able to say, this is what's causing the problem. It was sort of a black box behind the scenes of why is this happening? No one really knows.
Yeah, that's right. So think about, I guess, what's happening now with COVID-19, and economies have been stopped to a large extent because people just can't get out and spend money. I mean, you physically can't get out and spend money. So economies have been stopped for that reason. So back in the global financial crisis, economies had been stopped because lending had dried up pretty much all around the world.
Yeah.
And liquidity was a real problem in terms of no one was lending. Now, what you naturally saw then were even profitable companies at that point in time. And look, still a vast majority of companies were profitable.
Yeah.
Those type of companies actually stopped spending money as well, because the thought was, hey, we owe. Every company has some sort of level of debt, and they usually take on debt, obviously, to grow at periods of time. And they were a little bit worried. The thinking at that point in time was the worry was, will this debt get called back in from the bank that we owe this money to?
Will we be able to roll that over and borrow that and keep borrowing that amount, or will we get called in on that debt? So
that's right. So pretty much, you think a lot of consumption and spending money around the world is business to business, and that business to business spending dried up to a large extent because in any type of downturn in the economy, people put up a bit of a moat around themselves, and companies aren't immune to this. They put up a moat and say, okay, we've got this much cash now. We're going to hold on to that. We're not going to spend it in our usual fashion. So if you get every company doing that, then all of a sudden, you've got a problem. And of course, that spreads to the workforce as well. You've got employees who become worried because people get laid off, and they think, okay, well, I'm not going to spend my money, because if I hold on to my money, I mightn't have a job next week or next month. So I'm not going to go out and spend money.
So it becomes pretty much like we were saying, we in that euphoric stage, is that in both stages of the cycle, it's hard to imagine that it will ever change. So in that euphoric stage, it's sort of money, credit's easy to come by. People can borrow money. Businesses can borrow money very easily. A lot of people are spending money, so profits are high. It's sort of all looking rosy. And then that's kind of what we're talking about, the feedback loops of once that sort of narrative changes, and once it becomes a thing of not thinking, how do we grow, and how do we make sure that we're positioned to keep getting bigger and bigger. Once that changes over to how do we survive, and how do we just, like you were saying, protect what we've got, keep money in house, don't spend that, both at a household level and a company level. You can see how very quickly the velocity of that money dries up, and there's just not the same demand for assets and that kind of thing, and that's obviously what pushes prices down.
That's exactly right. Yeah, and look, and the thinking at the time always reverts back to, okay, this time it's different. This is the new normal. So the new normal is that no one's ever going to get a home loan ever again. These banks are going broke. People aren't going to be able to borrow money. Certainly not right now. And not for the foreseeable future. What always ends up happening eventually is that life goes back to normal, and the dust does settle. People realise that the world didn't come to an end. And they go back to starting to spend again. And in this situation, lending institutions started to lend again. But the ones that got the other thing too to remember is that when a bank goes broke, they've got all these customers that still need banking. They've still got home loans. They've still got banking needs. So what happens is another bank that's well positioned inevitably buys the bank that's gone broke or buys their customers, and that demand continues on.
And I was just thinking about, like the saying of this time it's different, and you hear that both, but you tend to think of it mainly in the negative times. So when things are getting really bad, and you're sort of saying things are going to get better, things will improve, and people sort of feel like this time it's different, maybe it won't. But that also happens on the euphoric stage, doesn't it? I mean, we've talked about this before, where in those boom years, it feels like the fun times are never going to end, and it feels like maybe this is the new normal. Maybe assets will just increase in price by 25% every year, and maybe we've come out of that cycle now where we have boom and bust, and maybe it's just going to be all good times ahead.
Yeah, certainly, and I certainly wasn't immune to that either. So, look, my own personal investments, I get a little bit carried away in 2004, 5, and 6 as well. So
that's what I was about to ask you. So I'm glad you went there. So it doesn't sound like I'm being picking on you. So and that's what tends to happen. So obviously the same thing happened to you. You got carried away when things were going good.
Yeah. So it's a good. My clients now have the benefit of my mistakes in the past. So So look, I guess one of the things that becomes difficult is to think that your situation is going to be stable and carry forward in the same trajectory that you're heading at that point in time. So look, I was on quite a good income at that point in time, working for that other financial planning business. We're looking back at 2004, 5, 6, 7 at that point in time. I invested quite a bit of money. I borrowed money to invest at what I thought were sustainable levels, and they certainly were. I didn't panic so much as my situation changed in that I became very unhappy at that organisation, and I looked at the way they were doing things, and I thought, gee, I want to do things very different from that. And so what that meant, so I decided in 2010 that I wanted to leave. I wanted to start my own business, and look, the markets were far from recovered at that point in time. So during those euphoric years, I had invested larger lump sums along the way that if I was going to go out and start my own business, and obviously take a big pay cut for a good few years, I had to make the decision where if I was going to do that, I would have to sell those investments for a loss, and realise quite a substantial loss with some debt against that, quite a bit of debt against that. Look, I made the decision to do it. I took a bit of a fair bit of a bath at that point in time. Now, in hindsight, it's been great because had I waited until things had recovered, it would have been another 5 years before I started the business. So as it turned out, we started in November 2010. Had I waited, we would have been starting in November 2015. We'd be 5 years behind where we are right now.
And
But
that's
look, it's a good lesson. Look, it was a lesson that I gained, that your situation can change pretty quickly, and it's not even necessarily where your hand is forced, but hey, I'm really unhappy in what I'm doing here.
Yeah.
And look, it is certainly good to leave some powder dry. That's for sure.
Yeah. Well, I mean, and we've spoken about this at length, especially when borrowing to invest. It's easy to, or anything that you do where you assume that your income will stay the same and that things will continue on. Nothing happens in a vacuum. So this is, I guess, what we're seeing at the moment is share prices are down by 30%. Now, usually it's because there's some economic issue behind the scenes. So it's not as though your income continued as it was and everything was all rosy and prices dropped and you could just bat your way out. That's I guess a big part of our planning, is to go, well, you have to assume the worst case is that what will happen here if there is a drop in my income and a drop in asset prices at the same time. So, and that's obviously what sort of happened there. So like you say, it's easy to extrapolate. It's human nature that we're pattern making machines. So we kind of go, I've been making this sort of money and I've been getting these sorts of returns. This will just keep going on forever. And so that's kind of where sometimes we have to be the voice of reason. And like you said, you had that painful experience. You had to learn that the hard way to some degree to then be able to talk about that with clients now.
Yeah, look, the benefit out of that is that that's certainly. Well, there's a saying. There's quite a common saying that fear turns to greed pretty quickly, and greed turns to fear pretty quickly. So the fear of the markets being down turns into greed really quickly when the markets are going strong. The lesson is that certainly, and sometimes we get clients come to us when the times are good, and they're saying, let's pull the trigger, let's invest all this money, we have to hold them back at that point in time. Because and keep quite a bit of powder dry. Now, it's not to say you don't want to take advantage of opportunities that come up, but certainly, look, I've practically lived that. On behalf of myself and my clients. So look, it's one of those good lessons to have.
And it's one of those things where, like we've said before, we've talked about this before. The human mind is basically designed to make you the worst possible investor. You most want to do the thing that you shouldn't do at the most inopportune time. And as a rule, like you're saying, that if you have 3 boom years and everyone around you is all making a fortune and everything's doubled, and you go, well, geez, if I'd invested this money 3 years ago, I would have doubled it by now. What was I thinking? Not just borrowing everything I could and throwing everything at it. It very quickly turns. At the peak of when we sort of feel the most greedy is probably when we should be most afraid, but that's not how it tends to work.
That's right, and look, the opposite of that's happening right now. It's a real talking point right now. People moving their investments and their superannuation to cash. And look, I know that just last week you had a client call you and it'd been someone that is. You consider to be a really good client who listens to what you say all the time, and they had listened to what you had said, and you told them, don't change your investment strategy. They were just double checking with you because all of their friends had said,
everyone around them is going.
Everyone around them had said, hey, we've all moved our superannuation to cash. And they felt a little bit like, I guess, second guessing, are they doing the right thing by staying fully invested? And once they touched base with you, you said, you are. And certainly we're going to speak a lot about that every week in our podcast as the markets are down now, because right now the biggest urge to do the wrong thing is compelling people, and that's to move out of their investment strategy and move into cash.
It's and it's interesting too, because it's a hard conversation to have often, where you go, yes, things have dropped by 30%, No, you shouldn't panic. You should stay fully. You should stay the course. You should stick to your plan. You know, you need to keep that money invested for the long term. But bearing in mind that we may well have another, as you said in the GFC, where things had already dropped by 30%, and then you have a week. In 1 week, share prices drop by another 15%. So that's never off the table. That sort of thing can always happen. So it's really hard to stay the course when it's sort of something where it's not as easy as going, okay, well, we know that it's dropped, but we know that the next step is going to be up. You just never know what the next move, what the next 10% move will be, whether that's going to be up or down. And so you have to sort of go, we have to stay invested because we need the long-term return, but we just don't know what's going to happen in the next 6 months ever. So it's a hard thing to hold in your head, to go, we need to stay invested even though we know this might continue to go down.
Yeah, absolutely, because the human edge is to obviously to run when you see danger. I mean, fight or flight it's classic, isn't it? So the urge is to flight.
Yeah.
At this point in time, because it seems incomprehensible to stand there and do nothing.
Yeah.
When there's a perceived threat.
Yeah. And that 15% drop in 1 week, that must have been, so like there's all the graphs that you see of the emotions that people are going through while invested, and you start to see things drop and they go through a bit of anxiety, and then full blown fear, and then panic, and then at the very bottom you see the word they tend to use is capitulation. So I can only imagine that having watched everything drop by 30% and staying the course, and then in 1 week watching that drop by another 15%, I can only imagine that there would have been people just going, I just can't do this anymore. I cannot emotionally hang on through this and come out the other side.
Yeah, that's correct. Yeah, there were. And certainly, I remember thinking, geez, when will this end? I know it's got to end at some stage soon. When will it end? I thought everyone that was going to panic had already panicked.
Thank you for listening to the Money Over 50 podcast with Lighthouse Financial Advisors. We look forward to catching up again soon.